You've heard that inverse yield curves lead to recession, and we're all so close to having an inverse yield curve. So let me simplify it for you. So inverse yield curve, let me explain real quick. The 2-year interest rate right now is like at 2.47, something to that. The 5-year, the 10-year, same thing. So the 5-year is basically, let's say, 2.48 because they're really close together right now. So how does that affect the recession? How does that lead to recession? Because it reduces lending. Here's what happens. The banks are lending out the longer term loans, whether it's a mortgage, a car loan, something to that extent. So they used to make a bigger difference. Now that they're inversing, right, they're going to lose money on their loan business. Understand, they're going to lose money because short-term interest rates are going to be higher than longer-term interest rates, right? That's what the inversion is. So when that happens and banks say to themselves, dude, we got to stop lending money out. Less home loans. Okay, so what does that do? That hurts the housing market that's been somewhat booming because of COVID. Less auto loans. What does that do? That hurts the auto business, which is gangbusters because we can't produce enough chips to create enough cars, right? To sell enough cars. So a lot of used car places, CarMax, Carvana, stocks like that are doing well. But the point is when the 2-year, and this time it might be a little different because understand we have CPI numbers, we have inflation numbers. The Fed already knows this is happening. So they already said they will be hawkish. Now, hawkish means aggressive. So the Fed's going to be aggressive with the action they take to avoid the US from going into recession. So I made an announcement a couple of weeks ago. 33% of the analysts interviewed on Wall Street thought that the US would go into recession. Now, a lot of them are just stating facts. Fact is, if the yield curves inverse, most of the time we will go into recession. Now, the chance that that won't happen is because the economy is pretty strong right now. The government just passed another chip bill. So we have, invest in the USA, build at home. Now you've got this chip bill. They want to put $26 billion on the table for NASA and the space program. So there's a lot of government spending right now. So it's really dependent on what the Fed does next. Again, if you ask me, I believe we have 250 basis point hikes coming up. First one, I believe, will be in May. And the second one, I believe, will be in July. Now, if you ask me again what my opinion should be, well, the Fed should actually implement 50 basis points in April and 50 basis points in May. And yes, it would put downward pressure on the market. Now, you're talking about the market, right? Certain stocks, Apple, up 16% since its low last week in 5 trading days. Tesla, 37% from its low 5 trading days ago. You have other stocks, Affirm up somewhere between 65 and 70% from its low of $26. It just crossed $47. So 26, 47, $21 increase. That's like 82%. Yes, I'm very good with numbers. I do this stuff in my head. All right. The point being, you've heard about the yield curves being inversed. Now, if it's a short-term inversion, meaning if the yield curves are like this and it stays like this, yes, the markets will be choppy. The markets probably will not explode with the yield curves right around. But as soon as there becomes some separation, you'll see some banking stocks do a little better. Now, banking stocks aren't all bad right now. Do you know who has a ton of deposits on hand? Bank of America. So when the 2-year goes up and the 10-year and the 5-year stay put and there's an inversion, the banks that have more money in hand, more capital, more deposits actually do quite better. So I'm looking at Bank of America myself. Now, also, quick alert, which I've already gave my platform today, but since everybody will see this tomorrow morning, I will tell you guys 2 heavy options activity. Lucid, when it was at $26 and change, they were buying the $30 calls that expire this Friday. So yes, Lucid's still up 27 and change right now, but it's far from $30. And they were paying, I believe, like somewhere in the, they were paying under $100 per contract. And the other contract that was being bought up, AMD. So it's the same people that were buying these AMD contracts last week. They're buying the 120s, right? Now AMD is at 123 today, dropped down to 122. When it dropped down to 122, they were purchasing the 125 calls that expire this Friday. You get it? So AMD 122, they're saying it's going to be above 125. Now keep in mind, they paid $80 per contract. So their break even is 125.80. So they need above that. Now, Nigerian, who made this announcement on CNBC, made a reference that these AMD calls, when they do things like this, generally pan out. He's in the position. I am also in the position. If you want, stay for the next video. I talk about good things all the time. Oh, Hood, real quick. Hood exploded today. I gave a video on Hood. I don't know, maybe it was 2 weeks ago. Hood was $12. I said my price target was $21. I explained in the video so you could see what I was looking at when I give you a price target, when I tell you where it could appreciate you. So from $12 to $21, that's 75%. If you like making 75% returns, watch my videos. I talk about stocks all the time. You wait for the entry that I speak about. There's one that's out there now, NET. I'm not hopping until $105. At $105, I'm going all in on net, okay? Chasing, that's not what I do. Have a great day.